Let's just get the obvious question out of the way. Do you think we're going to get 25 basis points or 50 tomorrow?
I'm looking for 25 tomorrow. So 25, in my view, is in line with the most recent Fed official communication before the blackout period started. And 25 seems to me a nice gradual way of starting easing cycles, which is historically the way the Fed likes to do things, particularly when the data are beginning to show that the economy's got a lot of forward momentum. So the Fed may have met its goal and feeling a little bit more confident on the inflation side. That warrants cutting, but perhaps not the urgency to start with 50s.
What do you make of some of the recent economic data we've gotten outside of just the jobs report? I mean, we've had retail sales numbers, we've had housing statistics, we've had a lot of metrics that seem to suggest that the economy is doing okay. It's not teetering on the edge, not necessarily going gangbusters, but it's there, right? I mean, people are spending, the economy is humming. Is that not right?
Yeah, absolutely. Yeah. The economy is slowing. We wanted it to slow. It was growing twice of its trend growth rate last year. So the whole point of tightening monetary policy was to try and slow things down and reduce the growth pace a little bit. But we don't have a recessionary impulse. And I think that's very important and what a lot of people might be missing. While we are seeing some loosening in the labor market, that's really coming from increased supply. It's not coming from companies firing people. And in fact, corporate margins.
Increased supply as more people coming in?
Yeah, exactly. We're seeing a lot more people coming into the labor force, and that is helping, I think, to mediate the inflationary impetus from the labor market. But what I think is important to keep an eye on is corporate profits and corporate margins remain near their historic highs. The consumer is doing very well, bolstered by falling inflation and declining gasoline prices.
Sophia, how big of a disappointment will it be tomorrow if we don't get that 50 basis point cut? I mean, we do have Nick Timiraos in the Wall Street Journal saying it's going to be a close call. We had an FT article saying the same thing. And investors are pricing in at least one 50 basis point cut in the next 3 meetings.
Well, about a week and a half ago, they were only pricing in 25 basis points, and the market and growth-sensitive sectors and assets seem to be doing very well under those conditions. So there might be a knee-jerk uncertainty that if the Fed doesn't quite meet the 50 basis point hurdle. But I think the bigger picture is the Fed would only be restraining itself and cutting 25 because the underlying economy is quite strong. So net-net, I still think that's a very positive message for U.S. assets.
Why is the Atlanta Fed GDP now forecast at 2.5% for the third quarter?
Well, it was just revised up to 3% after today's data, and it reflects the strength, I think, we're seeing particularly in consumption. So we are seeing a pickup in confidence on the business side as well as on the consumer side. And as I mentioned, some of these other factors, I think, are helping consumption with prices coming down, gasoline prices in particular. And I think on the corporate side, perhaps there's some relief that they do see the Fed cuts in the trajectory. And in that sense, 25 or 50 probably matters less than the direction of travel, as Chair Powell put it.
And it gets to the whole point, too, is that the actual release might be sort of a non-event. But I'm curious about the press conference and what Jay Powell is going to try to communicate to this market. Is there any sort of advantage to him basically saying that, yes, we are going to give the market effectively what they've priced in, 75, 100 basis points over the next few months? Or should he kind of keep his cards closer to his chest?
Well, you know, historically, at this juncture, there's a lot of uncertainty with how things are going to pan out. And so that might limit the pre-commitment that the central bank is able to offer. And in fact, that's what we've seen other central banks do as they've started their easing cycles, whether it's the Bank of Canada or the ECB or the Bank of England. They've started with the rate cuts. They've talked about how inflation is on a trajectory to come back to target, but they've left the exact tactics of the rate path a little bit unknown because there isn't quite that much certainty. And as we saw in the most recent CPI report, things can be a little bit choppy, even if you think you're on a path back towards a 2% inflation target.
So what does that mean for investors? Should they start positioning around a meaningful drop in rates over the next few months?
Well, I think we've already seen a pretty decent drop in rates, and I think investors need to focus a bit more on the growth outlook. What the Fed is doing is still very preemptive. You talked about 1995. That's the only other time in recent history the Fed's been able to stick the soft landing. And that was an environment where the Fed acted preemptively and early, as we think they are doing now. And that should just mean that there is less recession risk going forward. So net-net, that tends to be very good for risky assets, and equities and credit should continue to do well in that environment.